Hey y'all, good afternoon. Lisa Davis here, the Trusted Banker. It is Tuesday, March 4th, 2025. So today I want to start talking about Chime, a fintech company. I'm going to start a series doing fintech company reviews just so you guys know what to look for, what these fintech companies are offering, if they cost you any money. A lot of fintech companies are going to start popping up all over the place, right? These are going to be some of the different types of alternatives that people are going to be able to use, especially low income people, people rebuilding their credit, people that have been unbanked or debanked, people that are not of the rich and wealthy. I believe, and I see through all the different changes in the industry that they're going to start moving people towards these types of entities. So today we're going to talk about Chime. Now, Chime is a fintech company that offers banking products and services similar to what banks do, but they're not a bank. So let's see. So let's just go to their website just to take a look at what they say they are, who they say they are, and how they communicate and market themselves to the public. So here you see you can sign up for Chime. They have online banking, manage money, who we are, learn, and all these things. Chime is an online banking bank, as it says. But here, if you look at the fine print, right here on Chime, it says this is a financial technology company. They're not a bank. Banking services provided by the Bancorp Bank NA or Stride Bank are members of FDIC. Chime is not a bank. So that means if it is not a bank, your money is not insured by the FDIC. I want to make sure that I keep making this clear because people believe because fintech companies are either supported, backed, or partner with FDIC insured banks, that means that their monies are insured. And Chime does have some language there that says because we have these type of relationships, if your money is stored or if your money is deposited into one of our partner banks, then it'll be FDIC insured. The problem is it is not clear on the criteria on how to get monies deposited into these FDIC insured banks. And most of the time, when banks partner with other organizations, they don't take on their deposits. Even down here, you see it says Chime is a financial technology company. It's not a bank. Banking services provided by the Bancorp NA or Stride Bank are members of the FDIC. Now, the reason I started with Chime, make sure you guys read the fine print when you do this. The reason I started with Chime is because it's very, very popular and it's very, very misleading. But they've also been in a lot of trouble, right? So I'm gonna show you some of the and this is typical for any new company. I'm not saying it's good or it's bad. We're going to give it a thumbs up or a thumbs down when we finish this. You let me know in the comments how you feel. But newer companies like these fintech companies are going to run into problems, and a lot of times we find that these companies learn how to exist within the industry through their bumps and bruises. So right here is the first one of the consent orders. Let me show you first before we get into the lawsuit. Before we get into the lawsuit, I hope y'all having a good day. No, that's not it. Well, I guess we can just go to the lawsuit. So this one is Chime agrees to pay $3 million. Okay. So this one came out. So this is what the CFPB is. This is why the CFPB is important. And this is another reason that I'm going to do this series. Because if they dismantle the CFPB, the Consumer Financial Protection Bureau, this was the organization that kept all these fintech and digital companies in line if they didn't treat their consumers correctly. And now with them weakening or trying to dismantle it, you're going to need to know what you need to do in the future. But you're also going to need to know that this is the agency that will protect you. So if you want to complain to your Congress people and House of Representatives, then you should, because the CFPB is who protects you. So in this consent order, the CFPB found that Chime, a non bank fintech company, offers and provides international money transfers to consumers known as remittance transfers. So in this one, CFPB alleged Chime violated the EFTA and the remittance transfer rule, and they forced customers to waive their legal protections. Sendwave is another third party. So Chime is a fintech company that uses a couple of different partners to get all the things done that they have to do. And Sendwave was the entity that they used in order to send out remittance service agreements, which protected Chime from being responsible for losses to the consumer sending incurred using Sendwave. The CFPB also claimed that Chime limited its liability for damages to $1,000, emphasizing both provisions illegally restricted consumer rights under the EFTA, and moreover, the CFPB alleged Chime made false promises about the speed and cost of remittance transfers. Remittance transfers are transfers from one entity to another. And so that since they had to use a third party vendor to do it, it seems like it was a little bit slow and it didn't necessarily get everything done. They told customers that transfers would be delivered instantly or within seconds. And in many cases, transfers took longer than advertised. Chime also allegedly misrepresented to consumers how much it would cost to send money from the United States to other countries, and consumers were allegedly charged fees after Chime informed them that no fees would be incurred. So these are just things to watch for. So because they were found guilty of this under the consent order, Chime agreed to refund 1.5 million in fees to affected consumers. Now this only came to play because the CFPB got involved and took them to court and issued them the complaint that was made by consumers, right? So this happened from the United States to Nigeria from November 1st, 2021 to December 31st, 2022. So the fees that Chime has to pay back was a 1.5 million for that one. So let's look at another one. And these are the things when you decide to use these companies, I do understand that sometimes we are forced to have to look at different ways to do our banking, but it's also important that we look at the company as a whole and all the things that it offers and how much it can cost you. Read the fine print. So this is another one. In February 2024, Chime had to pay the state of California regulator 2.5 million over customer service flaws. So if the CFPB goes out, I think this is an important article for you to pay attention to because states have regulatory agencies as well that oversee fintech companies and in the financial industry, or banks too. They oversee banks in the financial industry in their state. So if the CFPB does go away, you still do have state regulators that do state examines and state testing and take state complaints. So Chime agreed to pay back 2.5 million to resolve an investigation into its accuracy and responsiveness in customer service transactions. In the consent order, which is this consent order here? Yeah, that's the consent order. So in the consent order, Chime is said to make a lot of occasional mistakes in handling or evaluating consumer complaints. The was time period, however, aligns with the article by ProPublica that focuses on instances in which Chime allegedly closed some customers' accounts against their will. They got roughly 920 complaints against Chime, and these had been filed with the Consumer Protection Bureau between April 2020 and July 2021. Nearly 200 were tagged as involving a closed account. So Chime at the time said the complaints were related to the fintech's attempt to crack down on accounts that use fraudulently obtained unemployment insurance or federal stimulus payments. So this is another thing about fintech companies. They don't have to follow any rules. So if this would have been a bank and they believed that there were some fraudulent dollars going into your checking or savings account, they can't just erroneously close those accounts. They have to have a reason to close those accounts and also meet with the customer or talk to the customer or something. So with fintech accounts, they can close them, they can limit them, they don't have to go through procedures because it is not a bank, it's a fintech company. If they want to pause your money, if they want to freeze your money, if they want to lock your money, then they have the right to do that. If they want to lower the amounts that you get, they have the right to do that. They have their own policies and procedures. So when you go to these types of companies, make sure you're not expecting them to act like a financial institution that has a ton of regulation that it has to follow. I'm not saying this is good or bad. I'm just saying be aware of what they can do, because I don't know if you guys remember when Robinhood, which is another fintech company, but years ago when the GameStop stock started appreciating and got high in value, all of a sudden GameStop stock went way, 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 way up to like $300 or $400 a share, and people were trying to pull their money out of Robinhood. Robinhood shut the site down. Robinhood did not allow anybody to sell or purchase during a set amount of time because they needed to stop transactions because they couldn't afford all the monies that we're transferring about. And that's a fintech company. If a fintech company wants to turn it off, they can just turn it off. These are the things that I want people to be aware of, because again, these type of companies don't market to rich people. They market to poor people, unbanked people, underbanked people, and people that are not fiscally savvy, or people that are trying to repair their credit. And they market to people like that because they're easier to access and get an account with than a bank once a person has hit a blip in the road and they're not able to get another bank account for some time. Is it a good place to start? Sure. Is it a place to stay? Absolutely not. Let's look at one more lawsuit that they had. Now, I just want to share these with you. Credit union. Well, let's also look at the FDIC and what they're saying about the signage so that you are able to determine if a fintech company is covered by the FDIC. Let's see, this is one for 3 million. What's this one for? This is for the transfers. Department, California. So we did 2.5 million and 3 million. That's enough. Let's look at what they offer, and then I'm going to take you to the FDIC site. So what Chime offers. So here's the thing. Chime offers you can get up to $500 before payday with MyPay, right? First of all, you can open up a checking account, a savings account, and you can get a debit card. Now, this is important because some people, again, have been unbanked. So if they're not able to access debit cards and checking accounts and able to get direct deposit or find ways to deposit their pay or their earned income, then they don't have ways to pay their bills and do the online transactions with that's easier to do with a debit card, right? So this does provide a service that some people can't get at the time. I see that they offer up to $500 before payday. Now, what I would suggest, again, is known to say that they open this for low income people, and $500 when rent is $1,200 is not a lot of money. So if I was your financial coach or something like that, I would say utilize this $500 before payday with MyPay as little as possible. Utilize it as little as possible. And the way that Chime works is they attach themselves to your bank account unless you get direct deposit and you deposit your paycheck into their online banking account. If I were your financial coach, I would say do not put your direct deposit into this account unless there's no other bank you have access to. Chime will connect to another bank so they can pull money from that bank account to this online account where they issue you a debit card so they can pay, so you can pay your bills, and so they say you can build credit and do credit repair here. If you don't have an external account and you have to deposit your direct deposit here, I would say be careful with that, understanding that they're not a bank, your money's not insured. And they did have another complaint. I need to find it that a person complained that they made a mistake and drained the account. It's right here. Let me see if I can pull this one up here. This one. So this one, Chime banking app refunds money to an Aurora woman after a scammer drains the account. First off, hackers are real. Banks have a lot of security on their accounts. They hired the best of the best of the best in information technology, IT security, to make sure that their accounts can't get hacked. And if their accounts can get hacked, if their accounts get hacked, they have a great security department that if any monies get drained, they pop your money right back into your account. That's one of the benefits of working with an FDIC insured bank. However, if you have to go to Chime and you don't have an option at this time, right? I just want to make you aware. So this woman had her money in Chime, and the money was drained by a scammer, right? These things happen. There's no way to think in a digital age that banks or fintech companies are going to not have scammers pop into your accounts from time to time and drain your money. It happens. It's just that banks refund you your money immediately while they do the investigation. And for this one, Margarita had a problem because once they got into her account and started draining her monies, she was trying to get her monies back and work with Chime. She lost all of her money, $671. This was her rent money, her bill money. It was all of her money. And by the time she got everything back, everything changed back. All her money had been drained. By the time she got it back, I think she said it was like 3 hours later. Within 4 hours of starting the case, she said she reached out to Chime. The first time, they denied her claim of fraud, and they also denied her appeal. Within 4 hours of starting the case, I had an email that said there was no fraud found and the case had been closed. Now, when you're working with a fintech company and they give you these kind of responses back, this is where the CFPB comes into play, because you can send the communication to the CFPB with other proof that your money was drained out of your account. And that's when the CFPB goes after companies like a Chime when you're not getting the customer service you need, especially if it has to do with your rent money and your bill money and your money, right? So eventually, see, Penny Lee, the president and CEO of the Financial Technology Association, said the industry is working to prevent fraud through campaigns like Smarter Than Scams. And all that's fine and good. But again, when your money is drained out of your account and you need your money now, you need your money now. And yes, we do have very sophisticated fraudsters. So Penny Lee says, unfortunately, we have very sophisticated fraudsters that are out there, and they're constantly 24 hours a day trying to find ways in which to maybe scam individuals. This is true. But again, if you're going to partner with a fintech company, just understand that when things happen, there's not necessarily any recourse or action, or there's no enforcement action or no regulatory action over these fintech companies in case they don't refund you your money or they just don't do the right thing, right? The Consumer Financial Protection Bureau took action against Chime for illegally delaying consumer refunds. And meanwhile, federal regulators are proposing new federal oversight. Now, this was in the old administration. The new administration is not working with the CFPB, and the new administration is not using the federal regulatory agencies to propose federal oversight for fintech companies. Not right now, and not for providers of digital wallets, and not for payment apps. That's not something that they feel is important. They are not encouraged to do this. They don't feel there's a need for it, and that is why they're weakening and dismantling all of federal federal regulatory agencies that have regulation over financial institutions. So just to be aware, right? I think, let's see. And this gives you common sense tools to use if you open up a mobile banking platform, change your passwords often, turn on two-factor authentication, and check your account regularly. Now, I always suggest that you check your account every single day. As a banker, I check my account every single day. I just want to make sure that people understand that these are not banks and your money is not insured. So if your money disappears, it's gone. And if we don't have any oversight agencies to protect consumers, then you can report it to your state agency, but there's really no protections out there. And while this industry is growing and they're building out new and more fintech agencies, it's just going to be some trials and tribulations while they figure out how they're going to do this. So I want to look at this last one with the FDIC, and then I want to give you a couple of things to take away on how to protect yourself, because if this is what I would do if I was at these companies. Let me just give you one update that I saw today with the FDIC. And I hate to keep going back, to what's going on in the country. But right now, we have someone in office that wants to start his own fintech company, and his partner, Musk, also wants to start a fintech company. So the deregulation is done purposefully because they don't want the regulatory requirements to, while they're trying to start their fintech companies. Remember, they both want to start a digital currency and they both want to have a fintech company. And a lot of fintech companies are just going to be coming up. It's just going to be the thing. It's just, that is what it is. So this is what I want to share with you. I don't know if you guys can see this. I don't know if you can make your screen bigger. But this just came out today. So the FDIC was in the process of updating their rules for their advertising requirements. Let me see if you can see that right. So this just came out today because now this has been put on pause, right? We in the financial industry, fintech has been around for maybe 10 years or more, maybe 10 years. And so there's a lot of changes that have to happen. One of the changes that have to happen, because this this has been not this has not been advertised very fairly to people, is that the fintech companies advertise that their partners are FDIC insured. And so a lot of times, if a consumer banks with a fintech company, they're not understanding that that doesn't mean that the fintech company is not insured. So the FDIC had been working on changing the rules around official advertising requirements and official signs. And I know this doesn't really mean a lot to you guys, but whenever you see the FDIC's name or logo, that means it is there on purpose, and that entity has FDIC insured funds. That entity insures the funds wherever you see that logo. Well, because the FDIC didn't have any regulation on how to use their signage and their logo, fintech companies started putting the logo on their company website or page or whatever. And so new regulation was coming out that they were going to change the signage rule so that if anybody partnered with a fintech company, it says in recent years, the banking industry and practices have changed significantly, including continued evolution of bank branches in serving depositors, substantially increased reliance on internet and mobile banking to access banking products and service, and the growth in the fintech technology companies working with IDIs. Now, IDI is an insured depository institution. IDI is an official insured depository institution. So when they release letters from the FDIC, it is moving towards a new amendment or change in the regulation. And so because of these new relationships and partnerships, the FDIC wants to ensure that there's a rule around how to help consumers better understand when they are conducting business with an IDI, an insured depository institution, and when their funds are protected by FDIC's deposit insurance coverage. So this means that for the rule, they want to modernize the rules governing around the display of the official sign in branches and extend the application of sign requirements to other physical premises, establish and require the display of the FDIC official digital sign on bank website, mobile apps, and other things, requires the use of the sign that differentiate insured deposits from non-deposit products across banking channels, and disclosure that certain financial products are not insured by the FDIC. Their deposits are not insured. You may lose value if you bank here or you put your money here, and your money will not be insured. So these are some of the things that they're working on. Today, they withdrew from some of that work. They had their final rule ready and they're pulling back right now, probably because the FDIC is under attack and a lot of people have been fired, so they don't have a lot of people to do the work. But we're going to keep watching this to see, because they have to have eventually the right signage for these type of websites and fintech companies, so that if you're somebody that's trying to reestablish your credit, reestablish your banking, you know who you're working with and you know who you're banking with, and you don't have your monies be vulnerable to hackers. So one of the things that I wanted to talk about also was, what should you do, right? Um, so what you should do if you do want to go to Chime. If I were to be coaching somebody that needed to rebuild their credit, reestablish themselves, and get a bank account, I would set a 12-month goal. Fintech companies are not for life. Fintech companies are not for years and years and years. If you have to go to a fintech company because you got unbanked, debanked, or you can't get a bank account or a checking and savings account, and you don't have a credit card or something like that, if you go to these kind of companies, go with the mindset that you're going to go for 12 months and no more, because it only takes 12 months in the financial industry to turn your whole life around and make it positive. We don't look at old credit, we don't look at past behavior. Every single month is a new month towards rebuilding strong credit and strong behavior. So if you open one, try to open one at a FDIC. In 12 months, your goal should be to try to open up an account at a FDIC insured bank. Move your account from Chime, close your account in Chime in 12 months, and open up an account at an FDIC insured bank. And then the third goal should be to get a credit card within those 12 months, a real credit card, not a secure card. The reason I say this, Chime says that their credit system helps you to build credit. It doesn't necessarily help you to build credit, because credit means you borrow money and you pay it back. Because Chime is saying they give you a secured card where you deposit money on this debit card, you spend money, and then you put more money on the debit card, that is not actually building credit. So this type of credit building vehicle doesn't build your credit as regular credit or as a real bank secured card. So different credit is weighted differently. So this is a minor credit, this is a minor debit card, and it's not structured as credit, it's not structured as a trade line, and it's not structured as borrowing money and paying it back, right? So because it's not structured heartily for the credit industry, my suggestion would be to get that credit card within 12 months. When you get to the 11th month of using a Chime debit card, where you're buying things and putting your paycheck money back on there and buying things, start to apply for a real credit card and try to get a real credit card, or get a secure credit card at Capital One. Go to a real credit entity that distributes real revolving credit. Because this is not revolving credit, it's going to weigh differently in your credit report. So if you're doing this to say to buy a car in the future, or to build up your credit so you can rent an apartment or buy a house, or whatever your goal is, make sure you have a goal for why you're repairing your credit and where you want to work towards. Set a time goal. 12 months can build up your credit. That's enough time to build everything to leave Chime. If your goal is to buy a house, and you want to buy a house, maybe you need 12 or 24 months. You need to get a real credit card to be able to buy a house, not a debit card. A debit card is not a trade line, no matter if they're reported or not to the credit bureau. It's not building credit in the same manner where it outlines if you're a good risk or not, right? In order to get a real bank loan or a mortgage loan or an auto loan. Credit is credit is extended to people that show up at the bank on paper as a low risk. You have to be a low risk, and in order to be a low risk, you have to have had experience with credit. Chime is not a bank. Chime is not issuing credit. Chime is a debit card that you put money on, you pay your bill, and you put money back on like that. So if I were you, or if I were coaching you, I would say give yourself a 12-month goal. Try to get into an FDIC insured bank within 12 months. Try to close your Chime account within 12 months, and try to get a credit card within 12 months. That's your goal. Chime is not forever, it's for a short time. It's not your forever bank, it's a short time bank. So that would be my suggestion to you. What does FDIC pass through insurance mean? Hold on a second. There is no, so that's the language that they use on the site. FDIC pass through insurance, meaning that if they pass your money through to the partner bank that they have that is FDIC insured, your money would be insured if they pass it through. This has not gone through and is not actual, and it also has criteria with it. So that means, maybe I should show you a question. Do I know how to show the question? So this is a good question, right? Because I did see this as a thing that they're going to try to work towards. There's criteria around this. So when you read it, read the fine print, because it says that some of our deposits will be deposited into our FDI insured partner bank deposit accounts. Um, it says conditions apply. Read those conditions. see if you qualify. If you don't qualify, your money will be sitting on digital air, right? So if something happens, they get hacked or they shut it down, that's it. You're just out of luck because it's gone. That's what that means. What is Cash App considered? Cash App is a fintech company. It states that your balance is eligible, but unless it's deposited at a bank, it's not insured, which is why the FDIC is coming out with regulation. That's why I just showed you that regulation. So let's go look back at that regulation, right? Because this has been a problem with the fintech companies. This has been a problem. So this is why the FDIC is coming out with language. Language means something in the financial industry. This is all the financial industry can offer you as far as to help protect you, right? Um, where was that page? So this is why this is important, and this is why I read it to you, and this is why you should look this up, right? The FDIC is trying to get signage out to help you guys understand if your money is insured or not, because that sign means something. If you don't see the logo on their website, they're not FDIC insured. We know we got insured depository institutions, and we know we got these digital companies, but because of the growth in the financial technology industry, right? They're trying to figure out a way to let you know if this fintech company is FDIC insured. So let's go look again at, and this is why it's important to read the fine print. It says right here, Chime is a financial technology company. It's not a bank. If it's not a bank, you're not insured, right? It says banking services provided by the Bancorp Bank NA or Stride Bank NA, members of FDIC. Let me tell you why this language is confusing and why they use it. The products and services they're talking about are the debit cards, the overdraft protection, the ability to transfer money from your account. Not that your money is sitting in one of their accounts. Unless you get a statement from their partner, your money is not insured. Okay, you have to understand that the money is not insured. Right here it says again, Chime is a financial technology company. They're not a bank. Banking services provided by the Bancorp Bank and the Stride Bank, members FDIC. But those banking products are the card, because Chime can't have a logoed card that can be used as a debit card to pay bills without a bank that partners with them. And if you go look up the Bancorp Bank NA and Stride Bank, these are different kind of banks that are very strong in issuing credit cards and debit cards and issuing lines of credits and to fintech companies or other type of entities that need those type of services, right? So these are different types of banks. They're different types of banks, but if your money is not in a bank and this place gets hacked and the CFPB doesn't exist and they decide not to answer the phone or talk to you, then that's just what happens. That's just how it goes. So that's why I'm doing these. So do I think I'm gonna give Chime a thumbs up, because one of the things that I didn't see is that they charge a lot of fees. I'm gonna be reviewing another one. Um, where's my page at? I'm gonna be reviewing another one called Dave, because I see that's a new one out in Florida, and that one I we're gonna talk about that one. But I did go through all of their products. I can't see all of the disclosures because I didn't sign up. I do see that they have an opportunity that you can tip them for their overdraft fee. This thing, Spot Me, if they cover any of your costs. One thing I want to say about overdraft fee, if you are trying to build your credit to eventually buy a house, be careful with overdraft services, because they show up and it automatically toggles you for denial. Because if you overdraw your account, it doesn't show good money management. And because it doesn't show good money management, you show up as a risk. And because you show up as a risk, overdraft fees do get you denied. Even if you have an overdraft product that covers your overdraft and replaces the money so it doesn't take your account into a negative. Even if you have overdraft services, you still get set up for a denial, because the thought process is when you're trying to get a bigger loan, right? Money management should be A1, and you should never spend more than you have. So be careful for these things if you're thinking about buying a house in the next 12 to 24 months. Because if we see these things on any kinds of accounts, overdraft protection, overdraft, whatever, that people have gotten their whole loan, their whole mortgage loan denied for that. I also wanted to talk about the pay before you get paid. This, I understand it, but the point of getting back bankable is to manage your money better. Again, I'm going to just say this. So, looking to get a payday advance of $500 when everything costs more than $500, rent, car note, groceries. I would say if I were your financial coach, I would make sure I tell you, do not do this. You don't need to get advances. You don't need to get advances. There's transaction fees and all kinds of things that are on the backside that might impact you in the future. But if you don't need the $500, don't take the $500 because it's a short-term fix. And the point of rebuilding your credit and rebuilding your ability to be bankable is to manage your money better. And that means don't overextend yourself, don't overspend, and make sure you're being responsible in your spending so that you don't need a loan every single month or every single week or whatever. So I would say stay away from those. Yeah, and with the get paid early and all those things. So Chime, I would give it Chime a thumbs up. It seems like the fees are there if you overuse their products. But if you get in and get out like you're supposed to, meaning if you get in to rebuild your credit, if you get in to utilize the bill pay services because you got a credit card, then yeah, it's cool. Don't get in to stay. Some people get in this and they stay for years. Get in this with the mindset that you're leaving after 12 months because that's all this is good for. You're not secure. It's not secure. It's not a real Visa. It's a debit card. You can get a debit card at the bank once you rebuild. So it'd be great to go in with the mindset that I'm gonna stay here for 12 months. I'm gonna do what I need to do, and I'm gonna go ahead and give me a real account so I can go ahead and buy my car, buy my house, buy my condo, or whatever it is you're working towards. Set some goals for yourself. Okay. You're welcome. You're welcome. No problem. So I'm gonna go ahead and post this, and I will do another one a little bit later today or tomorrow. And yeah, so if you have any questions or comments, put them in the comment section. And let's talk about all these fintech companies. I'll do one on Cash App as well. I want to go through the fintech companies because, again, I see that they're moving people towards that. So I want you guys to be aware of what it's going to cost you, the services you're going to get, and how protected you're going to be. All right. My name is Lisa Davis. I am the Trusted Banker, and I will talk to y'all later. Bye.